What's going on, YouTube? Welcome to the channel. I'm your host, Big Ben, and today I want to talk to you about some stocks that we have an opportunity to get into before I believe they go higher. Okay, so the first stock I want to look at on the screen is DraftKings, ticker DKNG. Now, DraftKings has pulled back. We had recent highs around October, and I believe as they get closer to earnings, they may make another bullish run towards the all-time highs, which is $64.19. And even if they don't reach $64.19, I believe that they at least try to pursue the $60 strike. Okay. So far, you see with DraftKings, we're holding here on a 20 EMA, which is this yellow line right here. And I was actually hoping that they pull back to the red EMA, which is my 50, or the blue EMA, which is my 100. Okay. So what I did for this stock already, I bought one leap and I sold two puts. Okay. If you were to get into the stock, I would sell puts personally here at the 50 EMA, and it's aggressive. The 50 EMA is $49.53, around that ballpark. Okay. If you want to be more conservative, then you can sell a put down here on the blue EMA, which is $46.54. All right. So let's look at the option chain. Now, what I usually like to do personally is sell puts 31 days out and lower. Okay. If I can find a deal within the 24 days left or 17 days left, I'll go ahead and I'll put puts on during those series also. But what I usually like to do is put a put on, receive at least $1 in credit per contract on each put. Okay. My max contracts I usually do is 5 contracts. So I'll take a look at next week's option chain, see where the dollar starts. Now, if you guys remember, it's around $49.53 on what an aggressive entry was on my 50 EMA. So if you see around here, the 49 to 49 and a half, if you play the 49 and a half, then you can receive in between $1.53 and $1.59. Okay. So it's fine to sell here, but you can give yourself a bit more downside protection if you come down here and you sell the 48. And this is the next week play. If you sold 3 puts at, let's say, $1.05, and you receive $3.15, you just let the stock kind of consolidate right above $48. And as time goes on, that theta decays and you collect more premium up until the expiration, which is the 29th of January. Okay. But as I was saying before, for me, it's an aggressive play if I come here and use the 49.50 strike or the 49 strike. But preferably, if anyone wants to play this stock and put on puts, then I recommend you come here and use the 48 strike. Okay, at least $1, and maybe buy like sell 1 or 2 put contracts. Right. So if I want a bigger premium, bigger slice of the pie, okay, as you see, 24 days out, you got some juicy premium in here. So the 49 and a half and the 49, now you're up in the $2 range. So if I sold the 49 and a half here with 24 days of expiration left, I can receive anywhere between $2.65 and $2.96. Now the bid ask spread gets a little wider here. It's not too bad. It's 31-cent difference, but you can put a limit order in and kind of bid yourself in and maybe get like $2.80. Okay. But to protect myself with this one, I will probably come here to the $48 strike and put on 2, receiving $4.30 of credit, letting DraftKings do its thing, while at the same time buying leap. I only buy leaps in my trading. Not only leaps, but leaps, in my opinion, are the best type of investments to buy because you get a whole 367 days to decide if the stock goes up, if the stock goes down, whether you want to get out of it, but you reserve a lot of your cash unless DraftKings just crashed. Okay, so if DraftKings went from $51, maybe $30, you can risk losing a good portion of your money, but at least you're not hit by a theta decay within like the first 6 months. Like I said, unless the stock comes crashing down. But with DraftKings, as you can see, this consolidation right here, and you can pretty much say this is between $40.04 and right here between $55.34. So for me, what I would do in the leap that I have, I believe it may be the 40, I can't remember exactly, maybe the 40 strike price call leap that I bought. And so for a leap contract or any contract, whether you are buying a put or buying a call, is 100 shares per contract. So this is similar to you owning 100 shares for those 367 days. But our objective is to take advantage of the run up in DraftKings. Okay. So on the chart, I have my target area around technically $70, but I have it marked specifically at $71.50. Do I believe we can do this in a year? Yes, we can. We can possibly also come back down here to $30 or $35. So anything is possible in the market. I don't know where the stock's going to go, but I'm hoping that we advance upward in DraftKings. Okay. So next stock ticker is Activision. Now, I'm very bullish on Activision. We have earnings coming up on the 4th of February, and I sold puts in the series. Okay, so I believe my puts are maybe around $89 or $90. But if you look at the series on these puts, which we will do, you can see that you can receive some real good credit in the running of earnings. Okay, and I also bought a call with anticipation of the volatility expand, so I can receive more credit and take advantage of when the market makers juice up the prices before the earnings call. Okay, so let's take a look at this. Oh, just in case, right here on my 20 EMA, which is the yellow line again, is around $89.14. Aggressive entry on puts or a put credit spread. More conservative around a 50, around $86.05, or you can come and be super conservative down here at the blue 100 EMA, which is $82.96, or 83 to round off. Okay, so we'll take a look at those. So, as I like to do, I like to go into the next week's series to see what I can get for at least $1 premium and 91.5. 91.5 is right here. That's a little too aggressive. 91.5. We're right on the gun where this can pull back, and we have to deal with the volatility of seeing it drop and go up day by day. So with puts, sell puts, you want to get to a point where you sell your puts and you just want the theta to decay so you can collect that money over time that you receive in premium. Okay, so you want to buy it back pennies on a dollar if you can. You want to buy it back for like 5 to 10 cents. But depending on how much credit you receive and how much money you are comfortable with taking off. Okay, so do this again. So look for $89 and $85. Let me actually go to the earnings series right here. Oh, look at that. Look at that, 91. So, ladies and gentlemen, you come here for 87 strike price and receive either $1.12 or $1.18 in premium. Okay. So what I would do here is come here at around the 88 strike price and just play two of these, bid in between, get like $1.35 a piece, making it $2.70 and credit, and until the earnings come up, just ride it out and collect the theta on it. Okay. So, like I said, I also bought a call in it. The calls I usually like to mine is at the 60 delta. It's right here, 60 delta, or at the 70 delta. So for this one, I believe I got in at maybe $89 even, but I just bought one call instead of buying 5. So I don't like to be too risky when it comes to buying contracts. I like to sell contracts in the market because, in my opinion, it's just the smarter thing to do, because you have millions, thousands to millions of contracts that expire every week. Okay. So if you want to, because I believe when Activision hits $100, it may pull back. But usually when a stock hits $100 within 3 months to maybe a year, the next run up is to about $150. So this would be perfect to play a leap on. Okay. So if we look at the leap series, 367 days till this contract expires, you can come here and play the 85 strike price, $1,600 to $1,700, bid in between, maybe get away with this for about $1,720 or so, or $17 even, which is $1,700. You, for the time being, are leveraging 100 shares of Activision. You go ahead and sit back, hope your stock continues its bull run, and then collect profits on the way up, or just sit back, set a target, maybe for like $150. As soon as you hit your target, you sell. You can easily profit maybe $4,000 to $5,000. Okay, but no telling of the market conditions. Okay, so this is why it always helps to get financial education and understand what you're doing exactly, what you're risking. Okay, so when I approach my situations, my mind state is, if I put in this $1,600 or $1,700, I have no problem with losing. Or if the stock was to trend down and become bearish in its position, I don't have no problem taking it off and retrieving half of my money from, if I invested $1,700. Whenever you trade a position, whether you're selling puts, the margin requirement, or if you buy risk calculated leap, or 2 or 3 month, 1 month or 2 or 3 month type call options, or put options if you want the stock to go down, buy puts. Okay. So next stock, which I'm kind of excited about this one, is Switchback. Okay. Switchback Energy has pulled back and it is holding long and strong on a 20 EMA. All right. So take a look here. The stock is holding. You got some people, a little bit of the community want to short it, but majority of people are buying it up as soon as it pulls back. Okay. So what I did for this stock is I went ahead and I bought a leap in it also. We have a dot here. For those of you who don't know what this indicator is, it's a TTM squeeze created by John Carter. I use this for a lot of my trading when I want to go long or short. This indicator, as well as every other indicator that's created, doesn't actual price of the stock in the future, because you can anticipate the stock going up, but the stock actually goes down. Okay, so use indicators at your own use. Okay, just make sure your risk tolerance, your risk analysis is under control. Okay, so what I did here is, when I buy a lead on a stock, this right here, if we break below the 50 EMA, which is at $34.48, then I may decide to sell my leap contract, reserving or pulling back the remaining monies that's left in there. Okay, I give myself a wide window, which you add that up, it's about $7 to $8 window. Okay, some people, they use the bottom of a candle wick to decide whether they'll get out and trade or not. But I'm only playing one contract, so versus someone playing 10 or 20 contracts, you want to be a bit more on your risk analysis, okay, and your risk control. So if you can sell a put here at $34.62, or let's say $35, which is conservative. Or if you want to go aggressive, you can come here at the bottom of the wick, sell a $39.40. Okay, so let's see what that looks like. So say 35, and let's say 40. All right. We got next week, 35, 40. Oh yeah, next week this right of money right here. This is what I would love. This is where I will come in. I'll put on 5 puts. Okay, I'll come here and I'll put on 5 puts, collecting that nice. I'm gonna say maybe $1.80 in premium per contract. Okay. As far as the leap, this well, so you can go to the 17th of December this year, which is 332 days away. But I mean, why not? For another 35 days, I'll stick with the January 21st, 2022. Okay. So what I would do if I wanted to buy a leap, I would come here and I would buy a 35 leap. Okay. On it, you leveraging 100 shares for about, maybe you can get away with that about 14.10 or 14.20. Leveraging 100 shares. And the switchback is hot right now, man. I mean, everybody in the market is trading. So you generally want to go with the crowd mentality on trading some of these hot tickers. So if you can afford it, like I'm trading it now short term, but I'll probably load up sometime in the future about 3 to 5 leap contracts. But if you want to play it close, I think what I have is I did a May 35, and I believe I paid about $1,000 even. Okay, I just want to ensure that I want the short move within the next 122 days. Okay, so if it don't pop within maybe a month, maybe the end of the 19th or the end of the 26th, I'll probably get out of trade because things will start to kick in a bit more, probably after about 80 or 90 days or so. So that's my recommendation. If you want to play this, man, I mean, I know a lot of people like to play the same week or next week. That's fine. But a lot of people that are trading nowadays don't understand about the theta decay, which is a real thing within your contracts. That's why I say that contracts are meant to be sold. No problem with buying leaps, but I personally like to buy 20 to 30 shares rather than leaps because the shares don't lose any value unless the stock go down. Okay, and shares you can hold on to for the longest beyond the parameters of a contract, because this contract you bought leap only lasts 367 days, right? So you buy shares, I mean, you can hold to it for the next 5 to 10 years or as long as the company is in business. And, you know, this can 2x be around $80 on its way to $100, and, you know, you're grabbing or collecting the benefit of the appreciation in your stocks or in your leaps, you know, if it does it all in that same year. My 3 stock picks, man. I hope you guys like them. Training videos coming soon. A lot of people need to understand how to trade the market rather than just buy stuff blindly, man. And it's coming. It's on its way. All right. But other than that, I'm still getting my feet wet with this YouTube thing, man. Trying to get everything squared away. Please like, subscribe. More content coming soon. Let's get this money. Peace.